In corporate finance, some mistakes are small, right? But others can literally make or break a company. Today, we're going to tackle one of the most common and frankly most expensive misunderstandings out there. What risk and the cost of capital really mean. Because wow, getting this wrong can lead to some truly epic strategic blunders.
And I'm not exaggerating. I mean, how is it even possible that one single number in a spreadsheet could swing a company's valuation by $60 billion? This isn't some academic brain teaser. This is a real-world problem that happens in boardrooms and M&A deals every single day.
Okay, so let's break this down. Picture this. Company A wants to buy Company B. To get the money, they take out a loan, and the interest rate is, say, 4%. Now, it's so tempting to just plug that 4% into your valuation model. But if you do that, the company you're buying suddenly looks like it's worth a whopping $80 billion. The problem is, based on the actual risk of the business, it's really only worth around $20 billion. That's a multi-billion-dollar mistake, all from misusing one little number.
So, how on earth do we avoid these disasters? Well, it all starts with a huge mental shift. We've got to stop thinking about the cost of capital as a cost at all. We need to start seeing it for what it really is, an opportunity.
And the magic words here are opportunity cost. Think about it. When an investor gives you their money, they're not just giving you cash. They're giving up the chance to invest that money somewhere else, in something with a similar level of risk. So the cost of capital isn't just an interest rate you have to pay back. No, it's the minimum return you have to promise to make them feel like picking you was the smartest choice they could have made.
And this right here is the core of the whole misunderstanding. A lot of managers look at their financial statements and see capital as just another expense, like rents or payroll. But the investors, the people actually writing the checks, they see it completely differently. To them, it's the price they're charging you for taking on your company's risk. What you see as a cost, they see as their required payday.
Okay, so this brings us to another huge myth. The idea that companies can really pull the levers and control their cost of capital. That if they just manage things a bit better, they can force that number down. But the reality? It's a lot more out of their hands than they think.
And this all comes down to a fundamental concept in finance: diversification. Look, smart investors don't just put all their money on one horse. They build a whole portfolio of stocks. And when they do that, something amazing happens. The weird, unique risks of any one company, like a product failing or a factory having issues, they all kind of cancel each other out. They get smoothed over. What's left is the one type of risk they just can't get rid of: the risk of the entire market going up or down. So let's think about this. You've got two flavors of risk. First, there's diversifiable risk. These are the things that are unique to your company. And since investors can just, buy a few other stocks to protect themselves from it, they're not going to pay you extra for taking on it. Then you've got the second kind, non-diversifiable, or market risk. This is the big stuff: recessions, booms, the stuff that affects everybody. That's the risk they can't escape, and that's the only risk they demand to be paid for. So what's the big takeaway here? It's this: your company's cost of capital has way less to do with your day-to-day operational decisions and way more to do with the industry you're in and what the economy as a whole is doing. For the most part, managers don't set this number. The market does.
Okay, so if you can't really change your cost of capital, what do you do when you're looking at a really risky project, like a big, ambitious R&D bet? Well, the way most companies handle this feels right, but it's actually completely wrong.
When managers get nervous about a project's uncertainty, what do? They just fudge the numbers. They arbitrarily tack on a few extra percentage points to the cost of capital. They call it a risk premium. It feels safe, right? Prudent. But honestly, it's often just a way to avoid doing the hard thinking about what could really go wrong. And the result? It kills off really good, innovative ideas before they even have a chance. And the damage this does is just incredible. Slapping an extra 3% onto an 8% cost of capital doesn't just nudge the value down a bit, it can absolutely crush it, wiping out 30 to 40% of a project's value on paper. Promising ideas get shot down not because they were bad ideas, but because of a lazy back-of-the-napkin way of accounting for risk. So here's the better way, the smarter way. Leave the cost of capital alone. It is what it is. Instead, build the risk directly into your cash flow forecasts. Don't just make one projection. Make several. A base case, a worst case, a best case scenario. Then you can start to have a much more honest conversation about what could really happen.
And why is this approach so much better?
Well, for a few huge reasons. First, it gives you way more information. You see the whole range of what might happen, not just one fuzzy number. Second, it actually forces you to be strategic. You start asking the right questions. What's our plan if things go south? And how do we get ready to scale up if this thing takes off? And finally, it creates realistic targets because you're admitting from day one that there's a best, a worse, and a middle road. But you know what? Even if you build the most perfect financial model in the world, there's one last giant hurdle we all have to get over. And that's our own psychology. It's our built-in, totally human fear of losing, and it can twist even the most logical decisions.
9%.
What's that number? Get this. In one survey, that's the percentage of executives who were willing to say yes to a risky project, even when the numbers showed it was a good financial bet. More than 90% said no. Why? It's simple. Loss aversion. Psychologically, we feel the pain of a loss about twice as much as we feel the joy of a win. And that little bias, it is absolutely crippling innovation in companies. So how do we fight our own brains on this? Simple. You change the camera angle. You zoom out. Instead of judging every single project like it's a do or die gamble, you start to see them as part of a bigger portfolio. And when you add them all up, a really cool truth pops out. The combined return of the portfolio is often higher, and the total risk is way, way lower than any single project on its own. See, a manager's job isn't to be some perfect fortune teller who never, ever loses a bet. No way. It's to be a smart portfolio manager. The goal is to build a collection of good, solid investments where, over time, the wins are going to crush the losses and drive the whole company forward. So I guess that leaves us with one final question for you to think about. In your own work, in your own decisions, are you letting the fear of one project failing hold you back? Or are you taking that wider view, building a portfolio of smart risks that are designed to create real, lasting value? Because honestly, the difference between those two mindsets, well, that's everything.